Welcome to Investing in Notes with your Self-Directed IRA. This is Alia, and we have Terri Gardner here as well on the line. We just got through a great presentation with Karin Hall from ViewDirect IRA Services, and I'm going to walk you through a presentation on how to utilize your savings or your self-directed IRA as a vehicle to build wealth using real estate, specifically real estate notes for an investment opportunity. So first I want to introduce myself and Terri. Both of us have a company called Investors in Action that specializes in doing loans in California. Specifically, we like to do gap loans, gap funding, which we'll talk a little bit more in detail about. We also are part of a larger company called Inspired Capital Partners. We have a team with over 140 years of experience. Really a varied background from brokering mortgages and deals to wholesaling, rehabbing, rental properties. A lot of us have our own portfolios respectively, as well as note buying and education. So we're just going to jump right into it. What you're going to learn today is two timely strategies for today's real estate market, specifically lending to rehabbers in your local market, as well as purchasing non-performing notes. And this is something that we do with the team nationwide. We're going to talk about why investing in paper assets is lucrative. The benefits of being a bank. This is something that Terri and I get super passionate about. And then the differences of owning paper versus the actual property itself, and why there's some pros and cons to both sides. We're going to discuss how we manage risk while maximizing profit, how we select our deals and evaluate opportunities for both purchasing the deal as well as the exit strategies that are so important to that. And then we'll go examples of those creative workout strategies. So I'm going to talk about the Goldilocks approach. This is kind of Terri and I's background into how we got started with real estate. We first started with rehabbing, and we realized that it was very time intensive. There was some risk to it. I really didn't enjoy jackhammering in 90-degree heat or tearing down properties. That was better left to somebody else, maybe with a little bit more muscles and enjoyed the great outdoors and swinging a hammer. Then we got into partnering, and we realized, and I'll show you an example of one of those deals, didn't go as well as we'd hoped, and so we wanted to avoid that and have a little bit more control over the deal. And then we've also invested in both single-family rentals and other forms of landlording. And while I don't discourage really any of these, we just tried on, different approaches and really found out what worked best for us. With single-family rentals especially, you have tenant headaches if you don't have a property manager helping you. But note investing was just right. Not too big, not too small. It was just right. And the reason why is it was lower risk. It was really minimal time. We structure our deals typically so that they're about 12 months or less in length, and the returns are quite nice, and we'll talk about that too. The result of that is creating financial freedom, and in many cases, especially if you're utilizing your self-directed IRA, a nice, comfortable retirement nut that you can hopefully count on long after, we assume that Social Security may not be around forever. So we'll talk a little bit about why investing, and there's a myriad of reasons why we chose to invest, and I'll talk about my story, as well as letting Terri talk a little bit about hers. But really, I was in a 9-to-5 job, and I know Terri was too when she started investing in real estate, and we just saw that as a way out. We had a great job. However, we wanted more control over our lives. We wanted freedom to be able to volunteer and create a family and stay at home with our families and friends and husbands, and really focus our time on our passions. For me, I was working at a charity, and I really just wanted to be a bigger philanthropist and have some more wealth so that I can give even more of my time and money. Terri, why don't you just jump in here and share a little bit about your story and why you wanted to invest in real estate, and specifically the notes, and what that's created for you.
Yeah, so I have a pretty strong corporate background, and most recently, just prior to real estate investing, I was working at Verizon Wireless for 11 years, and it just became this big company, this bigger and bigger and bigger, and they kept tightening the belt and laying off people that were very good, very strong, and the people getting promoted were ones that you're just wondering, okay, what happened there? I'm sure a lot of people can relate to that. And I just got tired of seeing good people get put by the wayside and other people that I didn't think deserve it get promoted. And I just felt like there had to be a better way, that if I'm going to work this hard and put in all of this time, that there was some other way to make money. The other thing that was such an issue for me is looking at my retirement. I was socking away as much money as possible into a 401k, and I just realized that that money wasn't growing like I thought it needed to grow. And that's why this is so great on the heels of Karen Hall speaking about how you can use your IRA, because you can self-direct it and you can grow it and have much more control over those profits. So my story really is I just wanted to take control back, becoming very disenchanted with corporate America, as I'm sure a lot of people can relate to, and just wanting to take control of my own destiny and make sure that I had enough for retirement.
Right, and I think that that's the key here, right? Because so many people are starving on Social Security, especially as insurance rates are going up thanks to our quote-unquote Affordable Health Care Act. You know, and really thinking longer term about their retirement strategy. I know I'm concerned about it for my family and for myself. So definitely, it's something to give some consideration to, and really one of the biggest benefits about doing this with your self-directed IRA is the tax-free portion. If you go in and have a traditional IRA that's tax-deferred, if you pay the taxes up front and start investing with a Roth self-directed IRA, you never pay taxes again on that money that comes out, unless for some reason you pull it out early. But if you follow the rules, it's tax-free, which is a huge benefit. So moving on from there, I wanted to discuss the differences and distinctions between investing in property versus notes, specifically real estate paper. So you define yourself as a landlord or a note holder. Being a landlord, you receive your rental income after everybody else, including the bank, the property manager, the taxes, the insurance. Again, if there's anything left, that's what you're left with. As the note holder, you typically get paid first, plus any late fees if somebody is late. So that's a huge benefit. As a landlord, you're responsible for tenants, toilets, and other headaches. As the owner of the note, you know, you're not responsible for maintaining that house. The owner is. So it's another great benefit. The landlord risks losing their home if they can't pay. If the note isn't being paid, the note holder actually has the opportunity to foreclose on the property and take that asset back, typically at a discount. And we'll talk a little bit more about our strategies when we buy non-performing notes. But we buy these notes at such a deep discount that if we end up having to foreclose, there's plenty of room left in between the price that we purchased it at and what is actually owed on the note, that we can usually make a substantial profit that way. The landlord is responsible for any damage that's done. If there's a major catastrophe, the note holder is insured as what's called a loss payee. And that's something that we do require whenever we're creating a note with one of our borrowers. Again, last to get paid at resale, last to get paid with rental income if you're a landlord. And the note holder typically has the safest position, at least well ahead of the owner's equity. So provided that it's recorded, that your note is protected, and usually in first position, maybe second position, but definitely paid before the owner gets any equity back. So let's talk a little bit about asset-based lending and describe a little bit more detail what that means. Let's assume that we have a house that's worth $500,000 in the Orange County area. And we would take a look at that, and let's say our criteria is we'll lend up to 65% on that particular deal. The loan amount is only $325,000, which means you have a protective equity or a cushion of $175,000 that could, vanish or go away before you ever risk losing any money on that deal, on that loan. So, you know, the purchaser of that deal has a lot more to lose or to risk with their equity position than you do as the note holder. Terri, why don't you go ahead and talk about some of the deals that we've done and how we structure a typical deal?
Yeah, so you can be a private lender on virtually anything. It can be commercial, it can be residential. And in fact, Alia and I, we have a loan on mobile home park, and we're looking at getting into storage units. But our typical deal, and really our bread and butter business, is doing loans on rehab deals, fix and flip, single family residence. And so we'll do for non-owner occupied 1 to 4 unit residential units. And we will loan, as Alia was just describing, up to 70% of the fair market value. And that's the fair market value after it's been fixed up. Now, we're in a bit of an upturn market-wise, so we'll go a little bit higher, even up to 75%. And if the market trends are going down, then we might tighten that belt up a little bit. We will also loan up to 12 months. So these are typically short deals. In fact, the average deal closes in about 6 months, 5 to 6 months, somewhere in that time frame. But we will write the note up to a 12-month term. And that gives plenty of time, usually, for the rehabber to go in, to fix up the property, and then have time to put it on the market and get it sold. We will do either first position or second position deeds of trust. And this might be a new term to you. And what we mean by that is, first of all, a deed of trust is like a mortgage. In other states, it's actually called a mortgage. In the state of California, which is where we do our primary business, it's called a deed of trust. And all that is a fancy word that says it ties the note, your promissory note, which gives the terms of your loan, directly to the property, so that the property is being used as collateral. Now, when that property is sold off, whichever mortgage or whichever loan or whichever deed of trust, is all pretty synonymous terms there, whichever one is in first position, that loan will get paid off first. Whichever one is in second position gets paid off next. So we specialize in second position notes, but we also do it in first as well. We'll talk a little bit more about the second a little bit later on. Our typical deals will get 8% interest or more. We write them as interest-only loans, and typically we get paid out on a monthly basis while the project is occurring. Sometimes we will wait and defer all of our payments until the project ends, but what's nice as a lender is you're getting paid as the project is going on, versus if you're the actual owner, you're not making your money until the back end. As I mentioned, we focus on non-owner occupied 1 to 4 unit residential properties and located within Southern California. And the reason why is just Southern California is our backyard. We both live in the San Diego market, and therefore, you know, anything in Southern California is drivable for us, and our investors are in this area too. So that's why we focus there. Now, ways to manage risk. We will always get the property valued by either a licensed appraiser or a broker. We get what's called a broker's priced opinion, and that's done by an agent, a real estate agent. And we'll get them to go out to the property and give us their professional opinion about what the property will sell for once it's all fixed up. We only use licensed brokers to transact a deal, as well as licensed escrow and title companies. So we want to make sure that all I's are dotted and T's are crossed. We will do what we call the takeover rehab test on each deal. And here's where, you know, for our borrowers, for the rehabbers that we work with, we can be their best friend in a lot of ways, because they will present a deal to us and we will go through that. We'll run the numbers as if we were doing the rehab ourselves. And because we have a background in it, we know what the numbers are and what they should look like. And if there's not enough profit in the deal, or if we don't think it's going to be successful, number one, we won't lend on it, but number two, we'll also share that with the rehabber so that they can take a second look at their numbers. So, you know, sometimes the lender can be your best friend for the rehabber. Another way that we manage risk is instead of just giving all of the money up front, we will have the rehabber take it in what's called draws. And so let's say we're loaning $50,000 on a project. We might give them $10,000 up front to get started buying materials. Once they've completed doing an initial amount of the rehab, then we'll do another draw, say another $20,000, and we'll put out what's called a draw schedule until we give the entire amount out. And that mitigates our risk because that way we're not just handing all of the money over and then let's say that rehabber takes off with our money and you know, goes on a nice vacation, and then we're left with this property that hasn't been fixed up. By doing it in draws that way, we're giving the money out little by little, and we're checking the progress along the way before we give the next set of money to the borrower, to the rehabber. We will only work with quality borrowers, and what we mean by this basically is we want to work with borrowers that know what they're doing. We look for rehabbers that have done at least 3 deals in the past because we want to make sure that they know what they're doing. If they're newbies, there's nothing wrong with newbies. We've all been there. But we really want to, in our lending business, work with those borrowers that are doing volume business. And that's typically a borrower that has their processes set up, they've done loans before, and they've got several deals running, maybe even multiple deals running each month. Those are the kinds of borrowers and rehabbers that we work with. If we're loaning in second position, then we make sure we have a relationship with the first position lender. So we will always understand what the terms of that note is. And we will even get a copy of the first position note to have for our files. That way we see exactly what the terms are. We see exactly what the payments owed are. And the reason why we do that is because let's say that the borrower, the rehabber, got hit by a bus, God forbid, and we need to foreclose on the property. Well, in order to stay in control in second position, we make payments and keep the payments going on the first position loan. And then we can go ahead and file foreclosure, take over the property, finish off the rehab, and we stay in control of it. And then the final thing that we do to manage risk is that we pay very close attention to the real estate market cycle. I was mentioning before about loaning at 70%. Sometimes we'll go up to 75% in an up cycle. Well, when there's a down cycle, we tighten up that belt quite a bit. So we definitely want to make sure we understand what's going on and which direction the market is going. So here's an example of a previous deal we've done. You can see the address here. It was in Los Angeles. And you see a photo. It's really just kind of your bread and butter home, your average working class neighborhood. The after repair value, now this was a couple years ago, so property values have inflated since then, but the after repair value was $260,000. It was purchased for $176,000 with a rehab amount of $8,900. That's actually a pretty small rehab amount, so it's mostly cosmetic on this one. There was a first position trust deed ahead of us. So again, that's that first position note that gets paid off first once the property is sold. And then we came in with a second position note of $40,000. So you can see by loaning in second position, we come in with a much smaller amount. And this was a combined loan to value of $70,000. So if you take that $40,000 that we loaned plus the $141,000 of the first position note, add that up, divide it then by the after repair value of $260,000, you get 70%. So that's that 70% marker that we talk about, still allowing some equity cushion. Now what's nice about this is the monthly interest that we got was 10%. And so that amounts to $341 a month. When you compare that to rental properties, you know, many of them, and I've got rental properties, Alia has rental properties, as a single family home, you appreciate, you look for a cash flow of around $341 a month. Well, here we're doing it as a lending deal. We're making that same amount of cash flow, but without any of the headache of owning the property. And we're in much more of a position of control by staying as the bank than if we were actually owning it as well. So you can make very good cash flow on a monthly basis with very little into the deal, only $40,000 in this case.
Yeah, Terri, I just wanted to interject too. What's really nice about this is if you're just getting started with your self-directed IRA or any other savings vehicle, what's nice about doing these second position notes is they're smaller compared to the overall deal. So it's a nice way to kind of get started with a smaller dollar amount versus trying to swing for, you know, a first position note. 141 is actually a pretty low amount in Southern California. We've seen first position notes higher than $1 million. So for a lot of people that's out of range, but coming in at 20, 40, 100,000 might be a little bit more accessible and doable.
Yeah, absolutely, absolutely. And you know, the other thing we've been talking about, you know, being the bank and holding the paper versus actually holding the property, holding title to the property. And this is really a great example of the picture you see up there on the top left. That was a property that we did in Los Angeles where we loaned the money on the deal, but we structured it as a joint venture. So we created a partnership. We brought the money. Alia and I brought the money, and then we had two other guys that we worked with actually do the contracting on this one. And we learned a lot of lessons on this. There was a loss on it. It's not, I mean, it could have been worse than what it was. It took a lot longer. The rehab came in a lot more. We didn't get any of our money until the back end. We didn't get our principal returned even until the back end. So we were making nothing on this. So we learned a lot of lessons, and now we structure it to be the bank. And instead of joint venturing where our name goes on the deed, on the actual property deed, we structure it so that we have a deed of trust and we are the bank. And since we've restructured, we've done small deals, we've done bigger deals like the one you see in the bottom right. This was actually a really beautiful home that was done in Rancho Santa Fe. It ended up selling for over $2 million. And made some nice profit. And since we've been structuring it this way over the last 2 years, we've made over $610,000 worth of profit on our deals that we've shared between both us and our company as well as other investors that we've worked with. So we love structuring it this way. You know, we've learned from painful lessons of the past and get smarter as we go along. So hopefully by us sharing some of these lessons with you, you can avoid some of the pains that we've had. And then on this next slide, you have just some of the photos of the properties that we've done. As you can see, that we have had some of the bread and butter homes as well as pictures of high-end homes here. I mean, these are beautiful, beautiful rehabs. And like I said, that's what we like to do, working with experienced borrowers that do really good quality jobs.
Yeah, absolutely. I look back on these deals, and so fun to just go out to the property sites on many of these and see the before and after. And really, for all those reasons, just describing the structure and the type of returns that you can get, we absolutely love being the bank. If you think about any, you know, major city skyline, if you look across the sky rises and see the names on the buildings, half of them are typically banks or some other like insurance company, something that sits in that position of control. And we really want to encourage you to think about your different strategies and potentially include notes as one of those. I'd like to go in and talk a little bit more about a different type of note deal, and this is the non-performing note sector. As we've seen in the last recent years, you know, we went through this major bottom out due to all the mortgages, and then now we're seeing a limited supply of deals, especially in California. It's different in every market across the nation, but California in particular, you know, we're seeing a shortening of REO short sales. Even trustee sales are getting super competitive. You have hedge funds going in there and buying for a top dollar, looking really only for a 6% return on their money, which is pushing out some of the smaller guys. And we really found that non-performing notes is another great avenue of getting involved in access to inventory. As you see here on this next slide, this is probably from about 6 to 8 months ago, but I'm assuming that this is probably pretty close to the same. I've just been hearing more and more reports of other banks that are releasing their note inventory still, while people are seeking and desperately wanting to find these REOs. There's just really no comparison. It's almost a 10-to-1 exchange between the number of notes that are out there and the number of REOs. And this is really a investment strategy. It's a little bit more advanced, and I'll show you some reasons why, but it can be extremely lucrative, as we will also go into. So this slide here just talks a little bit about some of the bank notifications. FHA announcing that it's going to sell 20,000 notes every year to investors for the next 10 years. Fannie and Freddie have also been mandated to sell $400 billion in distressed notes. That's just huge. So going on from that, I want to talk a little bit about the exit strategies for these non-performing notes. And you'll see here that you can sell the note, so you can find another individual buyer that might have an interest in notes. You can do a loan modification and then sell the performing note potentially as a two-part exit strategy. You can approve a short sale. So we'll show you an example of one of those that was a nice little home run for us. You can also foreclose. So we don't typically like to foreclose if we can avoid it, because there are attorney fees involved in that. However, again, because you're purchasing these non-performing notes at such a deep discount, you look at what does it cost if I need to foreclose and pay taxes when you're purchasing the note. So you calculate some of that information into your purchasing price and then back out your offer price from there. So foreclosure is always one exit strategy if you need to utilize it. You can also do a deed in lieu of foreclosure. We've also created a few other alternative creative exit strategies. Terri will talk about how you can donate a note and make a nice savings off of your taxes. So with that, I'm going to hand it back over to Terri to talk about Miss Chippewa Falls here and our deed in lieu that we got.
Yeah, so we wanted to give you a few samples of deals that we've done, because it always helps to just see numbers of some actual properties that have and notes that we've purchased. So this first one is in Chippewa Falls, Wisconsin. You can see the picture there at the right. The value when we purchased it was $25,000, and the unpaid principal balance on the loan on this property was $66,900. So it was underwater. And it was a non-performing note that we went in and purchased at $7,500 and change. So you can see for us, for just $7,500 in, we're purchasing the unpaid principal balance of close to $67,000. So we got a really great deal on this note. Now there were some taxes that haven't been paid of $2,657, if I could read the numbers there properly. So all in, we were at $10,000 and change. So what we did on this property is we actually did a deed in lieu of foreclosure. And if you're not familiar with what a deed in lieu is, it's really just what it says. It's you are given the deed in lieu of foreclosing on that property. So you need a cooperative borrower. You need to get a hold of them, and they need to agree to do this. And it still will affect their credit report to some extent, but not as bad as a full-blown foreclosure. So, and it's also faster for us. It's cheaper for us to actually just get the deed, not to have to go through all the court system and all that to actually do a full-blown foreclosure. So once we got the deed to the property, now we're the owner, and now we're in control of it, and we listed it for almost $30,000. We ended up selling it for $24,000 after paying some closing costs and some fees. We had a profit of over $10,000. So you can see by taking that sale price, subtract out our fees, subtract out what we originally purchased, and the all-in amount up there, we ended up with a very nice return on investment of this property. Now this happened, if you look at, we bought it in September 2012 and we sold it at the end of March. So it took about 6 months, and typically with notes you're going to want to allow that amount of time. It's not, sometimes you get a hold of the borrower and it happens very quickly, but many times you need to allow to actually let the process work out. And if it had been in foreclosure, it might have taken even a little bit longer, but definitely a great return on investment. Now we have another property here that took a lot faster. This one happened in a very quick amount of time. We were able to get a hold of the borrower. This one's in Missouri, and it was vacant at the time. The amount of the property was $25,000. The unpaid principal balance close to $69,000. Purchase price $11,000, and there was a small amount of taxes that were owed. So we were all in for $11,500. We ended up actually receiving multiple offers on this one, and we accepted the offer of $30,000. We had some fees involved, and so we had, again, a nice profit of this one for roughly $16,000 or 145% cash-on-cash return. So you can see, and the difference with this one, with the deed in lieu, we actually took the deed to the property. Now we became the owner, and then we sold it. With a short sale, we didn't take the deed. We stayed as the bank, and we had an agent work with the borrower, the homeowner of the house, to sell the property. And then we were the bank. We approved the short sale. And, of course, you know, we contacted the agent going into this, and we had a pre-approved short sale right off the bat. So it was a very quick transaction on our part, and, as you can see, very profitable. Now we have another
on these is just like the calculated ROI. If you can turn these properties quickly, I call them properties, they're notes, but if you can turn these over quickly and purchase more with the funds, you can really start maximizing your overall portfolio return.
Yep, absolutely. Now this one, Alia had alluded to it earlier. You can see a picture of the property there. It was vacant, in fact, very vacant, so much so that there wasn't even a home there. And what had happened is that the city had come in and bulldozed the property down. And they had put a lien against the property for their fees of bulldozing for over $100,000. And so you look at the numbers of that the current value of the land was $25,000, the purchase price was $7,500 that we were all in for. But then we have this other lien that anytime you have any type of city or government lien or taxes, that always takes a higher priority than any mortgage that you have on the property. So that city lien was in a higher priority or a higher position than our loan was. So we had to be accountable for that. Well, what do you do when the numbers don't quite work out? What we did is donate it to Habitat for Humanity. And Habitat for Humanity, being Habitat for Humanity, was able to go to the city and negotiate getting that lien removed. The city is doing something great for the community. Habitat Humanity is doing something great for the city. So what we did then is we were able to write off the current value of the property of $25,000, and that resulted in a tax savings for us of $2,600. So again, here's an example where the numbers don't exactly work out in the traditional sense, but because you have so many ways to exit the property, you can get creative, and you can still make a nice tax savings, which amounted to a 60% return on investment. Now, tips on buying notes. There are several things that we do. First off, before we've even purchased it, we'll get a tape of property. And what a tape is just a list. Usually it's in an Excel file with a bunch of properties listed on there. And they're selling the notes on those properties. So we want to confirm the value before we actually purchase the note. We need to understand what we're getting into, because if we do need to foreclose on it, we need to understand what we're going to need to sell that property for, or do a deed in lieu, or do a short sale. So we will have an agent go and drive by the property, make sure it's still standing, and give us their opinion of what it would sell for, and look at the other comps in the area and look at the neighborhood. We will also go on websites and do our due diligence online. One of the sites we use quite a bit is Trulia.com, And what's nice about Trulia is you can put in the address of the property, and if you scroll down the page, you'll see a tab that says crime. And you click on that tab, and it'll show you what the crime is like in the area, and will even give you a list of what types of crimes. So green means that it's very low crime, red means it's very high crime, and then there's a yellow and an orange that are in between. So we do not go into high crime areas. We stay away from them. They're harder to sell in. If you do end up taking title to the property and it's vacant, you tend to have theft. So we avoid the crime-ridden areas. The other thing we do before we buy the note, we want to review the collateral file. Now, we try to get a soft copy of this ahead of time and just make sure all the documents are in there. There's what's called an assignment, which assigns the mortgage or the deed of trust from the original party to the next party to the next party as it's getting sold off, and what's called an allonge, which transfers the note from the original party to the next party to the next party. So we just want to make sure that all of that documentation is in that collateral file and it's complete. We will also look at credit reports. Now, we do this specifically if we're buying a second position note. We want to really understand what the borrower is like. And the reason why this is important on second position notes, not so much on first position notes, is usually we'll buy a second position note behind a performing first, meaning that they're still making payments on that first position note, but the second position, they've stopped making payments. Well, our primary exit strategy there is to contact the borrower and get them to re-perform. Sometimes we'll do a loan modification and adjust their monthly payment, but we want to get them to re-perform on our note. So because we're not planning on foreclosing and taking over the property, we want to really understand what their credit is like, because we are now going to be in a relationship with them as they make payments on our loan. The other thing that we always do, this is extremely important, is to call on taxes and other liens. So you saw by that example of the property that got bulldozed, it had a lien on it of $100,000. And so, that's something you might want to know in advance. So we will call the property, we'll call the county of where the property is located and find out what the taxes are owed, and we'll contact the city to find out if there's any liens against that property. Now, some other things that we do, we will always collaborate with other note investors. It's actually a very small community. So we work with other investors. We'll buy notes from them. We'll sell our notes to others. And we do a lot of collaboration with what vendors are you using, how are you doing workout processes. We avoid daisy chains. Now, what we mean by this is, let's say the original note was originated by Wells Fargo, and then it was sold to another broker who sold it to another broker who sold it to another broker. Well, we don't want to be at the end of that broker to broker to broker chain. We want to get as close to the original source as possible. So we might buy, if we could, directly from Wells Fargo or a bank, or more often than not, we'll work with a broker that's one step removed from them. And we try to avoid, it's a lot of middlemen, right? So it's that same middleman philosophy that each one is trying to make their little cut of the pie. So the closer that you can get to the original source, the better, the less that you pay. And as I mentioned, it is a small community, so always with this business, with any business, do what you say you're going to do, and you'll keep yourself out of trouble and stay in good standing. Now, where to find note deals? We were just talking about trying to get close to the source. There are several brokers that have very good contacts directly with the larger institutional banks. FCI is a big broker. They have an exchange where they sell notes. They're a very large one. We will also work with hedge funds. Hedge funds, typically their business is all about buying these notes and then selling them off. And in fact, that's what Inspired Capital Fund, the group that we work with, that's what we do. We will buy large pools of notes, and then we'll sell them off ones and twos to smaller investors that are looking to just work with a couple of them versus buy in bulk. We'll go to conferences. There you can get a wealth of information at these conferences. One of the biggest ones is called Noteworthy. There's another one called Paper Source. They're both very good, and you'll rub elbows with a lot of other people in the industry. And if you're just getting started, one of the great ways to do it is to partner with somebody who is more experienced. They have the contacts built up. You can help do some of the work and offload and put in some sweat equity in exchange for working with them and taking advantage of their knowledge. We will work with servicing companies. A lot of, now these servicing companies, what that means is they are companies that will take payments for the loans. And many of them, because they're in that position of taking payments for loans, they work with companies and these hedge funds that have very large pools of notes. So they can be a great source of getting a whole bunch of tapes and a whole bunch of notes. FCI is a really good example of a servicing company. We've worked with Landhome, we've worked with Madison. There are a number of them out there. LinkedIn groups. If you go on LinkedIn and just type in distressed assets, you'll start to get ingrained with the community and get ingrained with other note buyers. Banks, if you can get directly to the bank. Now, it doesn't have to be a big, large one like Wells Fargo, B of A, any of those. There are a lot of smaller regional banks that maybe only have a couple of people in their office, and you can talk directly with the president and get right into somebody that has these loans on file for them. Now, laneguide.com is a great resource for locating banks all around the country, especially those smaller regional ones. And then finally, we work with, as we mentioned, note brokers. Make sure that it's a reputable one. Make sure that that you get references, that they do what they say they're going to do. We've worked with some that haven't been so reputable, and you weed those out pretty quickly and stay with the ones that you know do what they say they're going to do when they say they're going to do it. Okay, so what we've covered today, we've talked about a lot. We know we've thrown a lot of terms out and talked about a lot of information, but hopefully we've at least given you a good overview of some great ways to profit in today's real estate market. We've talked about buying non-performing notes, and we talked about lending to local rehabbers. So in either way, we're talking about owning the paper and how that can be profitable as opposed to actually owning it. And we've talked about ways to minimize the risk on our lending deals, and we've given you some examples, several both on the lending side as well on the note deal side. And we talked just finally here about how and where to find deals and how to get more ingrained in the community. So with that, we want to thank you for joining us. We hope you've given you some information to think about here, some ways of using your IRA to go out and grow your IRA, and some nice, interesting, good ways of doing it other than the traditional fix and flip properties or rental properties. You can do that as well, but like I said, we both really like, for a whole host of reasons, dealing on the paper side of it. My name is Terri Garner. Alia has been here, and then Karin Hall as well, talking about UDirect IRA services. We appreciate your time, and good luck with everyone. And if there's anything that we can ever do to support you in your businesses, feel free to give us a shout, and we've got our email addresses there as well as our phone numbers. Thanks so much, everyone. Have a great day.